Thank you, and I appreciate everybody coming back. And certainly, it's been 2 years and 3 years since I've been here, but it's great to be back myself. So I'm Bill Kelly, the CEO of the CAIA Association. We're a credentialing body, and we focus really on institutional quality alts, and we did not cover things like cryptocurrencies, digital assets, permission blockchains up until maybe the last 4 or 5 years, but now more and more we're seeing it in conversations, in content, in our curriculum as well. So this is a very timely discussion. And maybe by geography, I thought I'd point out we're 3 miles and 230 some odd years from the home of TradFi, which is the New York Stock Exchange. The Buttonwood Agreement was started and signed 232 years ago. And while there was no such thing as blockchain back then, it was a bit of a consortium ledger because you had 24 founding agents. And one of the founding principles was collusion. So while they had their separate ledgers, there was a consortium about how to charge commissions, who to trade with, et cetera, et cetera. And while there was no such thing as a security token back then, there was a non-fungible token or stock certificate, which was physical settlement. A security number was written on that, and it belonged to you, the individual. And trade settlement would take forever. But it's interesting to point out the first public company to reach $1 trillion took almost 225 years. It was Apple in 2018. So 225 years to get there to $1 trillion of market cap. And Apple was over 40 years old at the time. And contrast that to what we're going to talk about today with blockchain. The first crypto asset was about a dozen years in Bitcoin. And it got to that $1 trillion quite quickly. And there are many reasons why, and some of these experts will get into it, but it could not have happened without a decentralized ledger in blockchain, and certainly could not have happened without 24/7 trading. And I think gumming up the works of regulation is certainly some sand in the gears of progress there too. So we're going to cover all of that, but I want to start with some quick introductions. I think we're down one panelist, but that makes for maybe a more robust discussion. So Dennis?
Sure, thanks so much. I'm Dennis Crisello. I'm the head of wealth management for Onyx Digital Assets. For those that aren't familiar, Onyx is JP Morgan's blockchain business unit. We've been around for about 9 years now. Team is about 300 people large. We have 3 live applications on which we've processed over $1.5 trillion in tokenized treasuries and loans against them. My focus is in the wealth management space, like I mentioned, so primarily looking at fund tokenization. How do we expand the art of the possible using this technology? And my background is also in alternative investments. I was a portfolio manager for portfolios of hedge funds, private equity funds, and co-investments for about 10 years.
Thanks, Dennis. Charles?
Hi everyone. So I'm Charles. I come from SocGen. I'm in charge of structuring for digital assets over there. So we do have a small digital assets arm in France, and we do business mainly in Europe on digital assets. We started tokenizing bonds and structured products a few years ago using public blockchains, and I guess we'll come back to that a bit later. And now we are looking at expanding this business in the US, and we also have a more crypto-focused activities in Europe. We launched our stablecoin again on public blockchain. Our main clients are institutional clients, and we do work as well with crypto entities, market makers, crypto exchanges, and customers like that.
Welcome. Annalise?
Hi, I'm so honored to be here. And these two have the only stablecoins really in the industry, so the most forward banks that are out there. So excited to be on the panel. Annalise Osborne, I've been in this space since 2018, really focused on how do we upgrade finance and make it more efficient. I am currently the Chief Business Officer at 𝐏𝐀𝐍𝐄, which is a proof of work layer 1 blockchain. And I recently published a book called From Hoodies to Suits, Innovating Digital Assets for Traditional Finance, and I wish I had brought copies, so I apologize that I didn't.
Thanks. Anthony?
Hoodies to Suits, available on Amazon.com.
Well, it's, we're talking about learning about the industry.
It's a good book. My wife just finished it. Anthony Morrow, CEO of Providence Blockchain Labs. A longtime TradFi practitioner, 20 plus years at BNY Mellon. I ran a public REIT after that, and then I dug into blockchain, and now I'm paying for my past sins as the charger of intermediary fees at Bank of New York. I'm hoping to disintermediate myself, or my old self. Right now, CEO of Providence Blockchain, which is the world's largest real-world asset blockchain as measured by assets. A firm called Figure Technologies runs the only asset class that has been disintermediated by public blockchain. A product called Home Equity Line of Credit, done by Figure and Movement Mortgage and Guaranteed Rate to the tune of about $12 or $13 billion. It's a really interesting space, and look forward to digging in with everybody here.
Thanks, Anthony. So, Annalise, I'm going to start with you, and I'm going to start with hoodies to suits. So, would it be fair to say the hoodie is a public blockchain and the suit is private?
Oh, I don't want to get in trouble. Well, to me, the hoodie is technically the technology, right? And so you had entrepreneurs and technologists that they created this $2.5 trillion industry, financial system, but they did it without the help of the suits of us that have experience. I'm a former traditional finance person as well, that have the experience understanding regulation, securities, that sort of thing. And I think everyone needs to work together. Now, on the question of public to private, which is what this is about, when we speak to the banks, I think you'll find out there's a lot of regulation in this space, and the banks are the most heavily regulated, that when they're looking at actually working with this technology, most of them are working with private chains. Private chains, so information's not out there, they're much more protected. Private chains, depending on how you look at it, could be like a very large centralized database because they don't have the decentralization that public chains do. But banks are actually looking at, and asset managers. Asset managers have done public chains, but that's different. We'll get into purposes later. But the banks are actually, from what I hear, really looking at public chains because the future, I believe, is public. And I believe that they're similar to the intranet and the internet. So remember when companies were afraid of the internet, we all had intranets on our computers, and that didn't really, it was like a bulletin board, right? Versus the internet is free access to information. So I think that this is really access to finances, securities, what have you. So that's how I view the two worlds.
And maybe, Anthony, continuing this discussion. So with the definition of blockchain, I'm a neophyte in this to some degree, public-private, but also I saw hybrid and consortium. They sound like they're derivatives of public and private. Is that a correct understanding?
Yeah, I think you would put decentralized and public on one extreme and then private and permissioned on the other, and there's iterations of each. With JP Morgan and WisdomTree and Avalanche and some others, last year, we worked on something called Project Guardian, which was a private and permissioned instance of the public blockchain of Provenance. So that was a bit of a hybrid. And the beauty of working on something like that is JP Morgan ran their own nodes, meaning they controlled the network. They didn't worry about a distributed network. They actually controlled their own network, which means they controlled the tokenization, which means they controlled the fees and permissioning. So it was essentially as locked down as a centralized database. But the beauty of building in Provenance, for instance, is you can, with a touch of a button, you can use something called IBC to move over to the public mainnet at a point in the future when your regulators allow it to. So it really is the best of both, and you call that a hybrid, if you will, offering the best of both worlds. What you don't want to get into is a full, very expensive build on a private blockchain that isn't interoperable with a public blockchain at some point in time, because you'll have to stop what you're doing and then rebuild in the public blockchain. I think we all do agree that once the regulatory environment catches up to the technology, and regulation is always behind technology, it's just, it will never catch up, it's not supposed to catch up, the future is certainly public blockchain.
And I've got both JP Morgan and SocGen to my left, so very traditional, long-standing firms that have leaned into this trend quite heavily. So Dennis, maybe if you have anything to add on the definitions, but if I think about democratization and giving investors access to virtually any asset class out there, I think this is going to be a very innovative advancement.
Yeah, I mean, I would start by just adding on to what Anthony said. So as JP Morgan sitting in the US, we are very much on the private permissioned end of the spectrum today. And so we get the question a lot of times, like, why even do this on a blockchain network? Like, can't you just do this with a database or using like your real-time payment setup? And for us, we do see a future where a public blockchain fully realizes its potential. And so the way that we look at the world is like, let's build use cases today using this technology, using Solidity, which is Ethereum's programming language. And from time to time, we do these experiments where we can deploy what we've built onto public blockchains to ensure that we're doing it in a way that, should the time come where we eventually want to migrate, we can do so in a pretty smooth manner. And so that's kind of our approach, is this kind of building in parallel piece where we start with a use case that is not necessarily dependent on having this huge network effect up front, but things like our digital financing application or intraday repo application, as it's sometimes called, where you want it to work. And how does it work? One, it works because it's a shared ledger where everyone can see the same information. But the other, probably more important piece, is that you have multiple kinds of assets sitting on the same set of infrastructure, which doesn't happen today. And so this idea that you can have a token representing a treasury or a high quality liquid asset, and JP Morgan can lend against that with down to the minute precision is kind of revolutionary. And we're finding a lot of interest as far as different types of actors that want to use this intraday borrowing facility with the precision that they get from it.
And if I'm a client of JP, are there benefits to buying this asset on-chain versus off-chain? Because it sounds like you're putting some traditional assets on the blockchain.
Yeah, I mean, for us right now, the use cases are focused on utility. What can you do with this asset? And so what we do today is, we connect to tri-parties and we link them in. We link their clients' accounts in that hold these large amounts of treasuries. We will immobilize them in place. We'll issue a token against it to be able to issue, it's called 𝐏𝐀𝐍𝐄𝐋. It's our form of on-chain cash against these particular assets. And the reason we're doing that is to give this kind of precise form of lending. And we have other applications as well, which I'm happy to get into. But that's an example of, in our opinion, like the true power of tokenization is just as much about the utility that you get from this asset as it is like being able to access the investment itself.
And Charles, a similar business line, different set of regulations, different part of the world. What's SocGen's take on where we are with blockchain?
So we started like 5 or 6 years ago issuing the first assets on Ethereum, the public blockchain. So from day one we started and we chose public blockchains. We've been pretty vocal about that, saying this should be like the gold standard for everyone. Of course, regulation in different countries prevent us from doing everything we would like to do. But despite using Ethereum public blockchain, and as Anthony said, we kind of developed our own hybrid model. Of course, we don't want structured products or bonds, transferred to any kind of wallet throughout the world. So we did develop our own framework to kind of develop the permissioned access to our assets. And so we started with bonds, with structured products. And one of the missing pieces that we had at the time was how to settle these assets on-chain and have the full on-chain experience. So of course we looked at the stablecoins that are readily available on the market. None of them was, I would say, okay for us from a bank perspective, meaning in terms of transparency, regulation, what recourse you have over these assets and stuff like that. So that's why we came up with our own stablecoin as well on Ethereum to allow for that, I would say, full on-chain experience. We do have some and very interesting discussions with our regulators. So in Europe, we had the opportunity to launch this using Ethereum because from the early days on in France, the law recognized that the use of a blockchain was allowed to issue securities and to register ownership of securities. That's something that is still missing in most other parts of the world. And even today, we're still discussing with our regulators regarding how do we make sure that you can validate the transactions on the network that you don't really control. We do have BCBS guidelines that put a focus on public blockchains, and maybe we'll get back to that a bit later. But I would say our position is that public blockchains are or should be the way to go. But in the meantime, and time for us to get there, we are also ready to use private chains. This will really depend on where the clients and customers are comfortable with being active. The last thing that I will add is that on public blockchains, we could use as well the fact that we can educate our customers, meaning we started on Ethereum, and custodying or receiving our bond or structured products issued on Ethereum is really the same experience of receiving the Ethereum crypto assets. So for clients that wanted to start with, I would say, safe assets, bonds, securities, it was a way for them to test and to try public chains before moving to more exotic or risky assets.
And just a quick follow-up on regulation. So certainly here in the US, I would not exactly describe the SEC's relationship with the industry as friendly when it comes to digital assets. Is it a little bit more cooperative in the EU?
Well, in the EU, we now have a proper regulation over crypto assets, which is called MiCA. So we are a few months ahead of the curve. In the US, we do see some initiatives on public chains. We saw commercial papers issued a few weeks ago on Ethereum. So we do see some initiatives, but as Annie said, most of the banks here are looking at private chains.
So, Angelise, I'm more comfortable down here with the TradFi crowd. Having been in this industry for 40 some odd years myself, it's all been TradFi. So for both you and then also for Anthony, how do your business models fit into this ecosystem? Just so I understand it more myself and maybe the audience edification too.
Well, we're both blockchains, so blockchains really are not as fee generative. We have a token, so having been in the TradFi world for so long, it makes me giggle a little bit that now there's a liquid token, we have a cryptocurrency. So KDA is our token, and generally we get such a small fee for any transactions that are done, but we also have a large treasury and we would like more people to build on us. And so we encourage, we actually will help pay, we give grants out for people to build and use our chain. And then the more transactions and the more activity that happens on chain is generally reflected in our treasury. If that makes sense. So we're not really paid. It's very interesting. It is not what you would look at as a revenue generating company.
But it is profitable. It's a for-profit company, though.
We're for profit. Yes, a lot of blockchains have foundations. I don't know if Anthony does. Yeah, and so he can talk a little bit about that. We're just structured as one company. We have multiple different companies within our company, but yes.
So Anthony, your similar business?
The traditional model of a layer one blockchain is a group of developers come together, they think of a new way to build a blockchain, something that has attributes that existing blockchains don't. They go out and they build the tech, they do an ICO, and they say, oh shit, maybe we just issued securities. So they incorporate a foundation into Switzerland and they say, you guys are responsible for all that security stuff now, and then they go off and they continue to build. Not a great model. Obviously, the SEC had its list of layer ones that they think or thought were securities. It added a layer of confusion, certainly, into the industry. It wasn't the right way to go about doing it. That being said, there is no way to construct a public blockchain in the current environment that the SEC has. For instance, if you run a blockchain, you need to pay your validators in your token. That's the way you get a cryptographically true network. And if you know securities law, you can't pay non-broker dealers in securities. So you can't say all tokens are securities. So there just is no construct available for layer ones today. But to take a big step back, so all financial services networks, whether it's credit cards or custody banks or my old business depository banks, you have an oligopoly of providers inevitably evolves due to regulatory and compliance and interoperability. So think about Visa, MasterCard, or BNY Mellon and Northern Trust and State Street and custody. I think we're going to wind up with a very small number of public blockchains that register, ledger, and exchange the world's financial assets. And when I say register, ledger, and exchange, it's important to think about that because the credit card networks are messaging networks. SWIFT is a messaging network. DTC is a settlement network, right? So mapping all these things. Blockchains can do custodians or sort of layer 2s and layer 3s. And if you think about TradFi, you have the credit card networks, you have the issuing banks and brokers, you have the custodians, you have the DTCs. Those are all layers of a network. But most public blockchains, if constructed in the right way, they can encompass all those functions at the layer 1 blockchain level. So it does have the ability to do away with all those intermediaries. And all those intermediaries in TradFi exist because you need to bring trust into the system. I could sell you 100 shares of Amazon, you could pay me $100, but how do I know you're going to give me the $100, and how do you know I'm going to give you the Amazon shares? Well, if we had a distributed ledger, we could actually fulfill that trade right here on stage instantly. We don't need a T+3, T+2, introducing broker-dealers, custodians, DTC. We don't need all those people involved in our trade. We could face off bilaterally, and that's the promise of blockchain. And you could do that across all asset classes. Now, also important to know that securities will never be, the Bitcoin dream of anonymous and decentralized. Like you're always going to know whose securities. You're always going to have to be able to claw it back. These are not bearer instruments. You can't lose your keys. So you have to overlay all that when you think about crypto. So blockchain, is blockchain crypto? Is crypto blockchain? Yeah, they're interreliant on each other and they need each other, but they're very separate from an operational construct.
And maybe, Annalise, just staying with this for a moment. So you talked about intranet versus internet. If the dust settles 5 years from now, the world doesn't need 50, 100, thousands of different blockchains, I don't think, especially in financial services, because if I'm going to port my assets from one platform to the other, but these two blockchains are dramatically different, how do I do that? So there's got to be some standards, I would think. So how many blockchains are there in financial services, and do you see us sort of circling the wagons around a smaller number?
Absolutely, but there's probably 1,000 blockchains, but there's probably maybe, I don't know that we could even, I couldn't name off 100.
Too many.
Yeah, but I do, but I do think there's a smaller fraction that are working in the regulated traditional finance idea. There's there's not that many public, and then there's a lot of layer 2s that are built on top of, say, Ethereum, which is the main one. Because Bitcoin you can't actually program on top of. You can program on top of Ethereum, so that was the real benefit when it came out, is that you can have, in essence, a totally programmable bond that pays when it's supposed to pay. So that's kind of the difference between the two. There's interoperability as well. So I think you have to have standards. For example, I've started at 𝐏𝐀𝐍𝐄 a couple months ago, which was built by JP Morgan guys, kind of for finance. And then they were just tech guys that were creative because, as Anthony said, you just had tech guys building really cool tech. But the idea of kind of putting some sort of business behind that. Well, we're not EVM compatible, which means we can't talk to Ethereum. So now we'll be EVM compatible soon because that is a standard that we need to have to operate within the ecosystem. So I don't think no one can be an island. I mean, in business, no one is an island that is very successful, right? But similarly in blockchain, I do think it will narrow down because different chains are also generally identify themselves in different ways. So a lot of public chains have a large crypto component to them, and so this chain creates meme coins, for example, and maybe this chain is more NFT focused. So I don't think, even though there's so many chains out there, they're not really built for settlement of securities or bonds. So I do think, yes, there'll be a number of chains. I think it's not going to be one. I think it'd be more like 10-ish. But I do think there's huge benefits to private chains, which we can come to later, which is like the stablecoins that you guys have internally.
So for JP, just one blockchain or several?
Technically, we have 2 different blockchains. So we have one that's just for cash. That's our JPM coin platform. Then we have the platform that I work as part of, which is Onyx Digital Assets, which represents cash and assets, which we also deploy the JPM coin application within. So we have 2, I guess you could say.
And then I would think, go ahead.
Can I add to that? So you do, because you're a bank and you're regulated and you can't work on public right now, but what are you doing in Singapore right now? You working on a public chain? Or doing examples on public chains?
Yeah, I think you're referring to the Project Guardian initiative, and that kind of goes very nicely with like the interoperability point that Annalise made. So yeah, I mean, we've explored like what it would look like to use some very crypto native interoperability protocols to connect to Anthony's network as well as Avalanche using Layer 0 and Axelar. So we have done that work. Those have gone well. But again, like our live applications live on our private permission network, I guess you could say.
So I want to come back to that, though, Annalise. I think it's an interesting point. So from what I see, it seems like APAC is ahead of the rest of the world. And is that true or not? And then if it is it because they don't have a Buttonwood Agreement 232 years ago and all this legacy stuff that you have to worry about?
I think it's regulatory. I think in the United States, there's, when you're an institution, you've been around for a long time, you need black and white, and you need to understand what the rules are, which is why Mike has been so great, because you know what the rules are. In the US, it's all gray, and institutions can't play in the gray. So you can go over to Singapore where it's more defined. If you're working in a sandbox, it's easier to work in that jurisdiction. So that's how, I don't know if you guys think it's differently.
Yeah, I'd maybe just add, like, there's definitely a reg component to it, but there's, like, questions and, like, some drawbacks of some of the public chains as well, right? So, like, for the use cases that we have, they're large, chunky, multi-billion-dollar loans that essentially serve for some of these firms as, like, the critical plumbing for their businesses. And the fact is, like on public Ethereum, for example, there aren't great ready-to-use privacy solutions right now. And so as far as like, getting the right balance of the transparency and decentralization that public blockchains afford you, and also kind of like protecting the information that needs to be protected is a really challenging thing to do. And I know like a lot of chains are out there trying to solve this very problem, and I do think there is a technological solution to it. But right now, that is like a big concern that we have, in addition to like some of the like reputational issues of like, okay, you launched a money market fund on public Ethereum and you're getting, all these questionable NFTs sent to your wallets, and you're getting like potentially, stable coins that have been tainted by different bad actors in the space, and like it's a problem. So it is definitely a reg component, but there's other components as well for us at least.
And Charles, coming back to the blockchain for SocGen, are you using just one or several for your settlement?
We've been using two, Ethereum and Tezos, which is another public chain. To be honest, it's a bit hard to kind of predict the number of chains that we'll see, but definitely interconnectivity will be a key component. I mean, I've sit on a trading desk for a while before doing blockchain stuff, and one of the nightmare that we had was how to settle different assets class. Meaning, how do I trade carbon versus equities, for example, carbon credit versus equities? I mean, try to do DVP like that, it's a nightmare. It takes days. You have very low risk limits because of the risk, the counterparty risk. Tomorrow on blockchain, you can kind of remove all of that risk and trade any kind of asset versus another one. So it can be both assets can be on the same chain or tomorrow on different chains, but with proper bridges. It doesn't really matter as long as you keep the essentials, I would say, of the chains, meaning, you know, DVP, remove the counterparty risk, the settlement risk.
And I'm thinking if I'm a client of SocGen or JP Morgan or any bank for that matter, that if I want to have access to a tokenized asset, that has a value proposition associated with it. But then I would think more and more the consumer is going to want some kind of a stable coin, because then if I'm taking currency risk in Ethereum or Bitcoin, now all of a sudden I've got a very volatile settlement mechanism. So do you see the future being the underlying could be on or off chain, but more transacting in a stable coin?
Yeah, I mean, we hope so, and that's why we launched our own version of a stablecoin, and we got the proper licenses in Europe. But yeah, we do see high value in proposing our clients a stablecoin with which they can transact with us and with any other counterparty acting on Ethereum, actually, because these stablecoins are fully transferable. They are not like securities where we kind of maintain the off-chain register to make sure that I can do like the, you know, the tax report or the paying of the coupons. These stablecoins are free transferable, so I mean, anyone can use them and can come back to us and ask for redemption. So that's one of the great use case we think of the blockchain.
Yeah, I mean, for us too, like it's very important to have that stable coin as the payment leg of a transaction, right? But we also look at it like stable coins or, you know, like our JPM coin product, which isn't a stable coin, but kind of fits in that bucket a little bit. You could have programmatic payments, so the ability to be smart enough to write a contract that says, okay, like if this account reaches this balance, then move money from this account. That's really challenging to do in current banking. Like it can be done, but it is actually pretty challenging. And then the other thing that you get is, if you take a use case like a private equity fund, for example, a lot of times with distributors, they'll get a capital call for their 600-700 investors. They'll bundle it all together best they can. They send it over, and there's no transparency to the underlying investor, like who actually sent the funds. And what happens more often than not is somebody's late, somebody didn't show up, somebody didn't fund the account. And there's a lot of back and forth that goes on between middle office teams and transfer agents around like who actually paid for this thing, and having that ability to settle that capital call payment from the investor with the fund token, if you will, and give that distribution or give that transparency to this network is really powerful in our opinion.
Yeah, I'll just say that the stablecoin battles have just begun. Right? We're in the very early stages of it. First, you need stablecoin legislation here in the U.S. USDC and USDT in their current forms aren't going to be the things we're using 5 and 10 years from now. I think there'll be a yielding stablecoin where interest accrues in your account on a minute-by-minute basis. Figure Technologies actually has one on file with the SEC right now called Figure Certificate Corp. It's going to be called YLDS if it gets through the SEC, but it's a face amount certificate, going back to your Buttonwood comment at the beginning, using 40 Act regulations that allows for the only security that we know of in the SEC world that is tradable peer-to-peer without a broker-dealer. It's called a face amount certificate under the 40 Act. So everything is whitelisted, of course, so you have to be known to the ledger, so you can't be money laundering with it. And if we know you've been KYC'd by the broker-dealer, we can trade peer-to-peer. I can buy your 100 shares of Amazon for $100, and you can send it to me, and we can settle instantly and bilaterally. The problem with USDC and USDT is you're essentially loaning money to the private companies that run these chains, and you're not getting interest. You're funding, in the case of Tether, an incredibly profitable business run by the guys who run Tether, but most of it's offshore, and you don't know exactly what's going on there. So Figure does, as I said, about $650 million of HELOCs every month, which means they have a lot of ledgering and registering, but not a heck of a lot of exchange on chain, because a lot of the investors that are buying them are still sending wires to buy the assets. So when KKR buys a $40 million tranche of home equity line of credit, they're not comfortable doing a $40 million USDC transaction once a month because they don't want that risk, right? And sitting in a bank, you go risk by risk by risk, step by step by step, and you examine all the risks involved in each step. And someone in a risk committee is going to be saying, okay, you want us to give a $40 million overnight loan to the private company that runs Circle or Tether, and it's probably going to be fine, but I was around during the financial crisis when it wasn't fine. You know, these things, the chickens will come home to roost, if you will. Stablecoin legislation will help tremendously, and I know Circle and Tether, Circle at least is pushing that hard, and they should. But you know, my point is 5 years from now, digital money will be in a much better, more regulatory compliant and more profitable for the investor shape than it is today. And that will unlock all this stuff.
Go ahead, Annalise.
So you're talking about registering with the SEC, so your stablecoin is a security, it's not a stablecoin. So that is a difference.
It's a stable coin that acts like so it's a face amount certificate registered under the 40 Act, but it trades at $1 NAV, and it trades peer-to-peer.
So our coin trades peer-to-peer, and so
Right. And our coin's a great,
it's the same.
totally.
It's the same structure.
Similar, yeah.
But what happens with securities actually is securities, you have a whitelist, so you have it's KYC AML'd, so you can't you're not going to lose your token because you're always going to know who owns the token because there's a whitelist, so there's not issues with that. However, it is not a stable coin which can go to anyone. So you have to be on that whitelist for that to happen. Just clarify.
So the model, I think, is PayPal. So you sign up for a PayPal account, you're KYC, they know who you are. If you have your Web 2 interface, and that'll be the ideal, and Wisdom Tree does some of this now already. That's what you use to buy the coffee at a Starbucks, if we can get there.
But ultimately, the stable coin's got to be tied to a reference currency and a USD for the most part, and then collateralized as well.
Most of them are all USD. There's very small percentage that
And
are
backed
not
by
tied
collateral.
to the US dollar value of it. Yes, they're backed by, so I believe Anthony's are backed by US Treasuries, a basket of Treasuries.
It invests the way that Washington, D.C. life insurance companies must invest. I don't know why they picked that, but that's what they picked.
But usually there are. Most of USDC has European backed as well. It's just the volume is not as high because the dollar is the global currency.
So maybe staying with this thought for a moment. So I think when you first gave your introductions, and maybe Anthony, you talked about home equity lines on blockchain. So there have been non-financial use cases for blockchain, and we've seen that time and time again. As you're coming into financial services, it would make more sense if we maybe figured out a way of getting listed public equity on a blockchain first, but we seem to have skipped over that. I know DTCC has been working on this, but why are we settling T+1 when one is a day as opposed to a nanosecond? Why don't we try to fix that first? Maybe keep everybody happy. I'm sure there's reasons why we haven't done that, but maybe both of you could comment on that.
It doesn't have much friction because it can settle quickly now. So generally, the blockchain is looking to solve problems that have more friction, which is really more the private markets. There's different benefits that you'll get from each of the use cases that have come off, like programmable bonds, for example. Both these banks have done programmable bonds, which can be, in essence, self-paying unconditional. If you think about any bond, the legals of any bond, they're all in Excel spreadsheet, and so that can all be codified. So I think that's super interesting, similar to a HELOC, which is debt. I think funds are also, the efficiency if you tokenize a fund is that it is in essence you don't have as much paper pushing, and so you can actually go to more people at a less cost per head, which means you can accept a lower minimum. Some of the hedge funds have a minimum dollar buy-in, whatever it is, $10 million, and this way it can be $25,000 minimum buy-in. So that's a benefit as well. But also, when I look at, if we're doing this from a traditional finance perspective, you have to either make money or save money. And there's very few examples of programs out there that actually come up and say, we have saved this much money, except for JP Morgan and Figure and Provenance. Those are the only two that I believe, unless I haven't heard if SocGen has come out to say. So a year ago, and you correct me if you don't have to agree. So a year ago, JP Morgan coin had saved $20 million. This is when it was even not used as often in repo transactions because of I understand the charge of the difference interest rate. You don't have to charge interest for 24 hours. It's interest for, down to the minute. And then Provenance, I believe it was 150 basis points on transactions that were done. Obviously, it's dependent on the interest rate. Things are different. But that's a lot of money when you're doing securitization. So what we need, I think, for this to take off more is have more programs like these two have programs, as opposed to proof of concepts where it's a one-off show. one-off shows, you can't say we saved this much money because you don't have the examples.
So, Dennis, I agree with Annalise's points, but I would say make money or save money or raise money, and raising assets, I think, is a critical application. So Securitize might be a competitor of the two of you. It's a name I see in the news a lot. And I think it was Hamilton Lane, the most recent secondary fund, they raised about $5 billion. Very traditional setup, Cayman-based fund. There's a feeder fund on Securitize's blockchain. If you went into the Cayman fund, $5 million minimum. You want into the Securitize, $20,000. So I think that if I thought about the efficiencies, and again, I agree with Annalise's point that why try to fix something that's already efficient, but I think we're trying to take a very inefficient market using blockchain and other technology to mimic access and liquidity that we already have in the public market space. So is it the raising of the assets? That seems to be a big motivation in the private markets in using blockchain.
Yeah, I think that goes hand in hand with increasing revenue as well. I actually think like the access points and the liquidity points are pretty oversold, to be honest. I think just taking an asset that is a Reg D exempted security, private fund issuance, and putting it on a blockchain does not change who can buy this thing. So you may have like a $500 buy-in, but like as a qualified purchaser, do they care about that? I don't know. Like probably not, right? So I think a little bit of that, it's like somewhat oversold. The idea of like minimums coming down, there's no regulation that says like, this is your minimum for a private fund offering. And so, some of it is probably like access, some of it's probably marketing, but we do agree with the point that making things more efficient allows you to lower that minimum. I don't know if that on its own, like how much that actually does. And then on the liquidity point, just taking something on a blockchain doesn't necessarily make it more liquid, right? Like you need buyers and sellers standing by there. And so we kind of look at the liquidity for illiquid assets as, I'll say like a level 2 kind of opportunity. And so for us, first thing we want to solve for is making it easier to pass information, data, and assets through these pipes and making sure everybody is aligned on what exactly is happening at any given moment. And when you do that, then you have some of the key ingredients to stand up a better secondary market for illiquid assets. That market is pretty terrible today. It's highly brokered. It's very painful from a user experience perspective. It's very intensive as far as purchase and sale agreements. We think blockchain helps with some of these things, specifically around like understanding who owns this, changing the ledger, and affecting settlements. But there's work to be done there.
Well, from the outside looking in, though, I think it is underrated. And let me tell you why, and you can shoot this down or agree with it. So if I look at the wrapper for the private markets, the interval fund is the best mousetrap that we have. The problem with that is it promises 5% liquidity every single quarter. And we've seen this with S-REIT, with B-REIT, and the list goes on. And there's nothing wrong with the product. The end investor just doesn't understand how they should be investing in an illiquid asset. Come Securitize and a blockchain offering, and if it's permissioned, and I'll use Hamilton Lane because it's been in the public domain, in that feeder fund on the blockchain, if somebody wants out, I would assume somebody's got to play price referee. I don't think they're going to go to the feeder fund and start selling assets to raise liquidity. Somebody's going to have to find a price, and if the price, if they like it on both sides, trade happens. If it doesn't, no liquidity is raised at all.
No, I think that's the vision. To be clear, like there's virtually no volume today as far as like tokenized illiquid funds being sold in the secondary market. Nobody's really doing it. If they are, it's quite small. On the first point on interval funds, they're registered funds. Like that's a retail product, and so to me it makes sense there. But for like true private, true hedge funds, I think it's debatable.
Well, I think it's early days, and those crazy colluders 232 years ago down the Buttonwood in Wall Street, there was no market there either. They were creating it, and it grew.
No, don't get me wrong. We're bought in. That's part of the vision. That's part of the roadmap. I think it's just a little early to be talking about it.
Yeah, so I take your point. So we've just got, we're down to 6 minutes. So I want to maybe get back to the thesis of this panel, which is private or public, and I don't think that's for us to solve. I think we should talk about, and we have talked about the benefits and the weaknesses of each. But Charles, that SocGen and JP Morgan have big balance sheets, and that's a tremendous asset when you're trying to go from TradFi to DeFi. If you're a regional bank or a smaller player, where do you begin? Do you go and hire a couple of these experts down in the end to come in with the blockchain to consult? Do you go and hire a big consultant? Where do you begin beyond a big bank?
I mean, you may want first to look at where the market is going and not rush yourself into, splashing dollars on whatever blockchain you can find. So I'd say just maybe wait for the market to be created. I'm not sure there is a big premium for the first comers to this market. The markets will be created on, whatever blockchain it will be. And I mean, the assets will be there. People will be able to join at some point. So I'm not sure there is a huge premium for smaller banks to enter the market. I mean, we enter the market as a strong issuer, especially in terms of structured products. And we saw an opportunity for us to decrease our costs. We were talking about savings, but like the paying agent role, like this is very simple role where you just need to route cash flows to the investors. And tomorrow with stablecoins, you don't need that intermediary anymore. The issuer can fund on the interest payment date and automatically pay the coupons. So we saw that as an opportunity for us because we had a big business in terms of structured products. So it was a way for us to decrease our costs. For smaller banks with maybe no immediate use case, I'm not sure I would rush into these new markets.
Okay, thanks. So we're just down to a few minutes. I just want to give each one of you a chance for closing observations. There's a lot we didn't cover. We didn't touch custody at all, Anthony, if you want to allude to that, because that's always been a problem too. But closing observations on this discussion for the audience.
Yeah, I mean, first batter of the first inning is where we're at. And I know it's taking that first batters keep fouling off pitchers because he's been up for a while. But it's coming because the formula is, I think we touched on this, cheaper, faster, and safer. Crypto does cheaper and faster all the time, but they always forget about safer. I think if you can bring that third ingredient into the equation, it really does start to change. Decisions are made at banks and asset managers in the risk committee. They're not made in business development meetings or in the suite. They're made in risk committee meetings. And if you can reduce risk, reduce time, save money, you can bring all these ingredients together, you're going to start to revolutionize financial services. And the revolution will come asset class by asset class. It's not going to be a big bang. We're going to wake up tomorrow, we're going to see $1 trillion of assets tokenized. Each asset class has its own peculiarities and reasons to come onto blockchain or not for the foreseeable future. Public equities would be wonderful, but there's no friction right now, and there's a giant industry with a vested interest to seeing that it's delayed until their careers are over.
Thanks.
And we're seeing that over and over again. So it really is the asset classes that have a lot of friction. And the ones that figure has done so well is if you think about when you take out a mortgage, the 15 intermediaries and the wet ink signatures and the notaries and things like that you have to fill out that big stack of papers. Well, the process is exactly the same for a second mortgage, only the sizes are a lot smaller. So banks don't like doing second mortgages, but they've injected a significant amount of technology into the process, Figure and its partners, and they've disrupted an industry only because of blockchain. And as Annalise mentioned, they save about 100 to 150 points of the notional value of the loan, largely because you don't have to audit it next step when you go initial issuance to the warehouse to the securitization. And this is boring. This isn't what the crypto people want to talk about. They don't want to talk about audit, right? No one cares about audit. Conversely, when you go to figure.com and you take out a HELOC, the word blockchain or crypto isn't mentioned once anywhere, which is pretty remarkable given they're by far the world's largest blockchain issuer. This is back office stuff. It's not sexy. It's not supposed to be sexy. Like no one cares if you're using an Oracle database or AWS or GCP. It's just technology that works. It's cheaper, faster, safer. So a lot more to come.
Okay, the plumbing's important though in the basement.
Plumbing is important.
Annalise?
Education. I think if you're interested in learning more, that's instead of diving into the space or choosing. Anthony and I are not, Securitize is a broker-dealer, and they build on blockchain. So Anthony and I both represent blockchains. But I would just say, there's a lot of information out there, which is obviously panels and discussions. I would just say educate yourself.
And the hoodie and the suit, not
We're
or.
both hoodies and suits.
Excellent.
Yes, we are suits up here.
All right, good. Charles?
Yeah, I mean, I fully agree with the education. We still have discussions with some large institutional players or regulators where we need to start from the very beginning and indeed just talk about settlements and how this impacts our back offices. And these are not necessarily new assets. We are just issuing these assets in a new wrapper or settling differently. So education is key. Yeah.
Great. Dennis, final word?
Yeah, sure. I'll keep it pretty quick. agree with Anthony. It is very early in this space overall. There's a lot of noise, and so where you have real tangible examples, I think they're very powerful. So definitely appreciate Annalise given the shout out. But yeah, I mean, the idea is that we need to create value as an industry, and when we do, the assets will follow.
Excellent. Well, education, so get started somewhere, otherwise you will be trampled. But please join me in thanking the panel.
Thank you.